Abhiram Eleswarapu, the head of India Equity at BNP Paribas India, is now with us on the show. Abhiram, afternoon, and thanks so much for joining in. What's the call on the markets, right now? We've gone through nearly 1 year of consolidation. We've outperformed the global market, but we're finding it difficult to break out, but we're also not collapsing. How would you view the next 6 months now for the Indian markets?
Hi, Rima. Thank you for having me on the show. I think there are two major points that investors are looking at today. One is, of course, what you just mentioned, that India has significantly outperformed year to date. I mean, take a look. The market's probably flat year to date. Most global markets are down 20 to 30%. So the bar for further outperformance has just gone higher. And investors are now questioning whether there's more outperformance. The second element to watch out is that there is some evidence that quite a bit of the outflow seen in North Asian markets such as China found their way to India as investors looked at higher earnings growth and so on. And this week and the week after that, there's some important events happening in China, including the Chinese Party Congress. And usually that event is followed by some announcements of laying out a growth path for the long term, and also some potentially relaxation of COVID protocols and things like that. And we think that China could therefore open up a little bit faster than investors think. And my sense is that some of the outperformance that India has had over regional peers may actually start to go away in the next few months. So I think a critical event next week is the Chinese Party Congress.
Although, the big one is whether they will abandon their zero COVID policy or at least indicate a shift to it. One does not know. That's on Sunday. 254 down, by the way, and things are still remain down and out. So interesting markets. And of course, looking quite poor overall. Mazgaon Dock, which has had a one-way move, is seeing a large cut today, backed on the back of some very large volumes. It's down 7.5%. I think even after, it's up 18% after today's cut, just in October. Ambuja Cement is down 4%. India Cement, we highlighted some 11.5% cut. There's United Spirits, which is down 4.5%. Havells is down 5%. And so on and so forth. It's a big volume-led day on the downside, which we've not usually seen. Usually, even on down days, there is not too much momentum on stocks which sell off. But today is slightly more different with volumes backing this move. Abhiram, so what should the overall portfolio strategy really be? Where should one kind of concentrate one's money in? What should one get out or get in? What's your advice?
Yeah. So Prashant, of course, going by what I just said, I'd obviously be quite defensively positioned. But just before getting into sectors, I think one of the critical things that investors need to watch out for, and something that we've been saying quite a bit, is the earnings yield gap that we have in India today. It's below -2%. Such a scenario has only been seen a handful of times over the past, let's say, 15 years or so. And almost each time has been followed by a significant correction. So that's a very critical element to watch out for, in my opinion. On the other side, if you want to take a converse kind of positive view on the market, then maybe you could take the call that yields have topped out in the US or other places, and therefore you could have some sort of a rally in 4Q. But I think even in that sort of a rally, India may actually underperform, just given what it has done year to date. So in terms of sector positioning, I think obviously we need to go defensive and probably avoid sectors where there is a lot of debt, for example. The spaces that we like, first we continue to like financials, of course, selectively. Some of the large high CASA banks, I think, are still looking okay. Then insurance is quite good. I actually like IT and healthcare. It's slightly contrarian call there. But the view here is that those sectors have underperformed. They're not only classic defensives, but also fundamentally speaking, based on the results that we've seen so far, even from global peers, it suggests that IT demand is not really that bad, actually. So it's a space worth looking at, along with healthcare. And as I mentioned, just look at stocks that offer good dividend yield to top that all off.
Okay, I do want to take that point forward. You liking IT stocks, but just before that, the Nifty has now given up on the 200-day moving average quite effortlessly. It's now 16,976, so it's a slide of 1.5%, and it's getting worse by the minute. So not a good day at all for the bulls. But Abhiram, on IT itself, since you're keeping the faith here, and to be fair, companies like TCS have said that demand they don't have visibility, but for now they don't expect any client cancellations, at least for the next 2 quarters. What do you do here? Do you stick with the large caps? Do you look outside the index? Because there are some auto-related IT plays that have done quite well and have held fort despite the challenges. Where would your preferences lie?
I mean, I look at the playbook of previous slowdowns or recessions. Typically, what we've had in IT is that you tend to have a couple of quarters where there's not a whole lot of growth or maybe no growth. If you're in a recessionary kind of environment, once you factor that in, then you'll probably see that the risk to maybe revenue growth estimates are probably around 2, 3, 4% maybe. But what tends to happen in such a scenario is that the large cap companies are able to offset that with better control over their costs and maybe their attrition. And the earnings cut also tend to be proportionate and much lower than what you tend to see with mid and small cap companies. And usually we've also seen during downturns that larger companies tend to hold up their order books a lot better than the smaller ones. I'm not sure if there could be a change this time. There's a structural change maybe with mid-cap companies trying to do better, but the playbook of the last several slowdowns is that large-cap companies have come out better during a recessionary environment.
Okay, talking about IT, tomorrow HCL Tech 2 will be reporting numbers, and here the key is going to be, does the company hold on to its this year's margin guidance? The margin guidance for HCL Tech for FY23 is 18 to 20%. In Q1, when margins came in at a decade low, HCL